Hello knowledge seekers, you travel a lot? Do you spend most of the time working and you don't have time to read? Don't worry, we've got you covered. Audiobook channel will provide summarized audiobooks just for you. We only get you the best of what book pages hold. You just sit tight and enjoy listening. Chapter 1 of The Intelligent Investor by Benjamin Graham is titled Investment versus Speculation, Results to be Expected by the Intelligent Investor. In this chapter, Graham explains the difference between investing and speculation and how each can affect an investor's results. Graham defines investment as an operation that, upon thorough analysis, promises safety of principal and an adequate return. On the other hand, speculation is an operation that does not meet these requirements, but instead involves buying and selling securities in the hope of making a quick profit. Graham emphasizes the importance of avoiding speculation and instead focusing on investment. He argues that speculation is inherently risky and can lead to significant losses, while investment, when done correctly, can provide a steady return over time. Graham believes that investors should prioritize the preservation of capital, or the amount of money they have invested, over the potential for high returns. Graham also stresses the importance of thorough analysis and due diligence when making investment decisions. He believes that investors should carefully research a company's financial statements, earnings history, and management team before investing. He also advises investors to avoid making decisions based solely on short-term trends or market movements, and instead to focus on the long-term prospects of a company. Overall, Chapter 1 of The Intelligent Investor lays the foundation for the rest of the book by emphasizing the importance of investing versus speculation and the need for careful analysis and research when making investment decisions. It is a timeless lesson that is still relevant today and is essential reading for anyone interested in achieving long-term financial success through sound investment principles. Chapter 2 of The Intelligent Investor by Benjamin Graham is titled The Investor and Inflation. In this chapter, Graham discusses the impact of inflation on an investor's portfolio and offers strategies for protecting against its effects. Graham starts by defining inflation as the decrease in the purchasing power of money due to an increase in the supply of currency. He then explains how inflation can erode the value of an investor's portfolio over time by reducing the purchasing power of their money. Graham argues that inflation is an important consideration for investors and that they should take steps to protect their portfolios against its effects. He offers several strategies for doing so. Invest in assets that will maintain their value during inflation. Graham advises investors to consider investing in assets that will maintain their value during inflation, such as real estate, natural resources, and commodities. Invest in bonds with inflation protection. Graham suggests that investors consider investing in bonds that offer inflation protection, such as Treasury inflation-protected securities, TIPS. These bonds are designed to protect against inflation by adjusting their principal value based on changes in the Consumer Price Index. Avoid long-term fixed-income investments. Graham advises investors to avoid long-term fixed-income investments, such as long-term bonds, as these are particularly vulnerable to inflation. Consider equities. Graham suggests that equities, or stocks, can provide a hedge against inflation as they are often able to pass on price increases to customers in the form of higher prices. Overall, Chapter 2 of The Intelligent Investor emphasizes the importance of considering the impact of inflation when making investment decisions. It provides practical strategies for protecting against inflation and building a portfolio that can withstand its effects. By following these strategies, investors can help to preserve the value of their portfolio over the long term.